Now we get to pick up on U.S. demand, and as we said before, we saw the drop in demand. It was something that we thought was going to happen, driven by gasoline. We didn't expect the same size drop in distillate, but again, it's an imperfect science, and it's always going to be an imperfect science. So is the drop in distillate too much? We're going to say yes. Gasoline actually has a little bit further to go in terms of that makeup number, but you're still seeing that we're still well off of what is normal and kind of these normal paces. So one of the things, as you can see, is we've just re-rated to the lower end. And we will get an increase. It's just going to take time as to when do we see that increase come through, because it's going to be weighted based on what is driving it in general in terms of where things are underlying in some of the different pieces. Because when you look at the weather side, it's gotten a little bit cooler than expected, but again, still nothing crazy that's going to drive a meaningful increase in heating oil demand. And then on the distillate side, trade is still slow, a little bit of an increase in trucking, but nothing crazy. We had another big bankruptcy, as we said earlier, and there's just not too much happening on the distillate side and the diesel front. And gasoline, as we said, we had weather, we had February break. Then we have a lull. Then we start to get some spring breaks kicking up. Then we have some more spring breaks going through. Then we have Easter. So that's when you start to get a little bit of a bump. It's not quite summer driving, but again, you start to see those increases, which when you look at previous years is very normal. So what we're saying is demand is going to go up. End period, done. Demand gasoline side is going to go higher. It's just going to be at a rate lower than what is quote unquote normal, looking at it from 2017 to 2019 in terms of those different levels. So now when we look at where things are going forward, again, distillate, small build of 140,000 barrels a day, fairly balanced as to where we saw the builds. Imports were slightly down by 55,000 barrels a day, but you can see it. It's just we should still be getting draws, and we're just not. We're just going sideways. Slight increase, steady rate, but as we've been saying, the comps get easier because we normally get this dip, and you normally don't start to see that flatten out until the end of March, beginning of April, which is why we're just going to run essentially right into that 29-year average, which is still on the lower end versus previous few years, but it's still, again, as you can see, above where we were last year. We're 8.4 million barrels a day above where we were last year. We're still 10.7 million below the 5-year, but you can start to see it's balancing out a little bit more as we get less demand from the trucking side. Remember the economic drivers, as well as the heating oil, more of the weather side. So with some of these different trends, you're getting some pressure again in the diesel front month, the diesel crack in general. You can just see it's coming under pressure. Still well above where it was from 2018 to 2021, but at the very low end versus 2022. And this has been the big driver. So as this weekends, and not to say that we don't see it going to 30 at this point, but you can see it's the new rate is this fairly tight level between, let's call it 38 and 42, 43, and that's where we've just been living, and there's not much to break us in any one direction except storage. And as storage builds, especially as some of these refiners start to come back from their earlier turnarounds, you're going to get more of this in storage, which is going to push the crack down a bit more. Pad 1, fairly flat, still at the low end, but you can see that we should normally still be getting draws, and we're not. And as that kind of flatlining, we're still going to be in a bullish position, because with a flatlining here, we're still going to be below the 29-year average. But it's just because, again, it's not driven by demand. Demand is still terrible. It's just we're not getting imports that we normally used to from Russia, from Europe, just because of the Russian sanctions. So more of this product is being sloshed around, and it's just harder for the U.S. to compete which is why these are going to stay on the low end and rely on what comes up through the Colonial Pipeline. So then when we look at distillate in PADD 3, again, fairly stable, flattish. They're going to try to manage these flows. And it's going to be a matter of what goes into the Colonial, what goes into the international market. And the international market is getting more and more competitive with the diesel coming from Russia. But the question is, who's going to take it? Because we get a lot of this back and forth in terms of who's going to be willing to take it in general. So we've seen Brazil, there's about 3 cargoes floating offshore, and it's just a matter of if they import it, what is the developed market going to say? And realistically, at the end of the day, it will get imported because it's going to be priced to perfection or priced to the level where you'd be foolish not to. And yeah, so people might be annoyed that Brazil took some in, but again, they have an inflation problem. They have a drought in some areas, some flooding in others. They have their own problems to worry about, which is why they're going to import this. And the Russian diesel will price itself to such a point where most countries are going to take it in. Obviously not the developed world or EU, but some of the emerging markets, some of those developing countries are going to take an opportunity on that cheaper diesel, especially because inflation is a massive issue for everyone, especially the emerging markets. So why not try to take these in? Distillate product supply. So for those that have been following us, our view is that we were going to stay within the cloud at the very low end, but within the cloud. And here you can see that pretty sizable drop. Now, there's normally a drop now. You can see that the timing, this happened a little bit earlier. It'll average out. We still think it's going to just stay at the very low end of this cloud. And not to say that there's going to be a resurgence in demand, but this is even a little bit lower, especially because we did, a little bit of a flatlining on the trucking side. And it's just, trucking is not going to go to zero. You still have to move stuff around the country. It's just, we're not going to be moving stuff around the country the same way we did in 2021 and 2022. So those benefits are going to drop off, or at least that saving grace that we had the last 2 years. And now we're just catching up on what normal trucking looks like. And we look at this, and it's important to look at it over the last few years. We're just coming back closer to where we normally have been. The problem is there was such an overhire, new stuff coming in over the last 2 years that there's a lot of price competition and there's a lot of margin that has been essentially diminished from this. But realistically, we're just coming back to normal, and the new normal is lower, and gasoline being less people going to the office, flexible schedules being pretty much the more common form of things, is just going to keep things a bit capped, and you're not getting any real support from the rail side. Rail total carloads down slightly, grains a bit down, but again, that'll bounce. It's just always about timing and levels. Petroleum products higher. Realistically, coal is going to continue to be strong as they try to prepare for summer burn. But intermodal is down 11.1%. Again, there's just less stuff moving, especially on the intermodal side. So the rail companies that have the most exposure to intermodal are gonna struggle, just because those were some golden years, and there's a lot of problems going forward when we look at not only just on the consumer demand side, but also on just general economic growth. And again, it follows through, and this just shows you what's coming onshore is just 52% for this week, 34.8% below last year, 39.09% versus last year. There's just not as much quote unquote stuff coming into the country. So there's less stuff to move around the country, therefore less diesel demand, less marine gas oil. And again, we're last year was a surge year, so it's not like we have tough comps. We should be down versus last year, but to this level of being down is sizable, which is why we're even below where we were in 2019. And that's even that was a fairly weak year, but it just gave you kind of a normal year. We're still low against that. Some were saying on the trucking side, February was one of the worst months they've ever seen. And it's not that we don't see much more happening. It's just, again, we're going to be bumping along this bottom, given the fact that underlying economic growth is struggling. And here's what we're looking at on the weather side. And you can see it's slightly below normal. We're not looking at, oh my God, there's a massive polar vortex coming in. In March, we're going to see negative degree weather. No, it's slightly below normal. So what is normal in the beginning, middle of March? Is it 53, 54 degrees? If you're further south, is it 58 degrees, 59? So you're 5 to 7, maybe 10 degrees lower. You're going to be wearing a jacket, but is your heat going to be kicking on? And again, that's why we've seen natural gas come down. We've seen heating oil come under pressure, and a lot of this is going to be a problem. Now, this is an interesting piece. With the least U.S. interstate natural gas pipeline capacity on record was added in 2022. So you're just not seeing a lot of new pipeline capacity. Columbia Gulf Transmission increased Mississippi to Louisiana. Florida Gas Transmission west to east from Mississippi to Mobile County, Alabama. Florida Gas Transmission from Mississippi to Alabama. A&R Pipeline from Wisconsin. From Illinois to Wisconsin. So when you look at some of the flows, the problem is you're going to have a huge glut of gas in the South, but there's no way or easy way to get that gas north. So, and again, speaking selfishly from the private equity side, we're buying, hydroelectric plants in the Northeast, in the Midwest, in the Southeast to a degree. And the problem is when you look at this, it's like, well, yes, will be a lot of natural gas. There's a chance that Henry Hub will be fairly capped, even with the new LNG capacity coming on. But none of that is making it north. And that's when you're going to start to see the disconnect, and we've already started to see it, between natural gas pricing and electron pricing, or the forward curve on power. And that's the key piece. That's what we keep seeing where, even in Europe, you've seen natural gas prices come down, but electricity prices have stopped coming down and actually started to increase a bit. And that is going to be an underlying fundamental problem when you look at the disconnect, because you have coal facilities coming off and you're not getting the natural gas there to replace coal with natural gas. Instead, a lot of places are replacing coal with wind, solar, and some short cycle gas, but not to the same degree of the coal that's being taken offline, which is going to create lumpiness. And the problem is dispatchable power is going to be a problem, because lumpiness is an inherent issue. Because if you're going to get a heat wave, that means that typically heat waves, you have very little wind because of just the structure of wind. You may have strong solar, but you're going to lose your wind. And do you have enough solar to maintain that? And typically when you have a heat wave, it's pretty hot at night too, and the sun's no longer shining and the wind's not coming on. So how do you fill that gap? And that's where you're going to see this issue with the total dispatchable power that's available to make up some of these numbers. But again, that's a bigger conversation for a different day. Here, when you look at gasoline, you had a small draw of 1.13 million. That's still 10.3 million versus the 5-year, and 6.5 million versus last year. But look at the level of drop off. When you look at it from 2021, really any year, you can see that there is a sizable drop through the first half of March. And our whole goal, our whole view is that we just don't get a drop. We'll continue to drift lower, but it's not going to be meaningfully lower because demand's not there. So because demand's not there, imports came in 227,000 barrels a day. That's 162,000 below the 5-year. So you're just having imports slow a bit, and you're just kind of coming in at this fairly flattish number. Now, if we look at blending components had a draw of 3.08 million. So realistically, we should get another a sizable drop in gasoline next week, but then we should see a little bit of that drop off. And there's a certain amount of that makeup, because everyone's preparing for summer grade versus winter grade. So that's going to be a movement of blending components, making sure that they have the right blending components for the mix that is required on that on the RVP level, or the Reed vapor pressure ratios, which is why you have winter versus summer blends. So when you look at blending components, and again, we had a drop, but we normally have a drop, but the rate of change is going to slow, which is going to put us very close to what is normal. Now, when we look at the Gas Buddy model, Gas Buddy had us at 8.368 million barrels a day. And if you think about the EIA, we were at 8.56. So again, for those that have been watching us, 8.4 million, that's what we've been saying. We've been in a fairly tight range. So Gas Buddy's seeing what we're seeing because we're looking at TomTom, we're looking at Gas Buddy, we're looking at EIA. We look at all of these data points. We look at toll roads, toll bridges, because we want to see, look, where's the trend? Is the trend going up? Is it going down? And clearly it's coming down a bit, but flatlining. There's not too much. And then so far every day this week, which is Sunday to Tuesday, has seen below last week's levels for U.S. gasoline demand, which is going to come in a bit lower. Again, there's still time to make that up, obviously, because typically a lot of the driving happens between, let's call it Thursday and Saturday. So we should see a pop, but is it going to get us to 8.7? No, it's just going to maybe get us back to 8.35, 8.4, just very stable, but very much below what is normal for this time of year. So then when we look at trending levels, here you can see that on the North America side, Asia Pacific has balanced out. Europe has bounced back a bit. But when you look at 2022, we normally kind of get a bit of this bounce back. And as you look at Asia, something similar. And then North America just bouncing around a bit, coming back up. But again, we see a little bit of that trend coming down, but not meaningfully. It's just below normal. And that's something that is going to be the common thread as we progress through the year, and something that we think is going to be, let's call it, catch the market by surprise in the summer, because that's the shock. And the reason why we say that, and it's not because we're sitting here saying, oh, well, we're just bearish. It's like, well, let's be realistic about it. For those that have gone out to eat, I'm sure, even though you could afford it, you didn't get up and leave, but you probably had some sticker shock when you went out to dinner in January and February. There is sticker shock within that. I don't know if you've looked at hotels. With my wife and I, we've looked at hotel rooms. The prices are high, and a lot of times it's not because demand is there, but because their underlying costs are so high. And not to say that people won't go, because they will. But the problem with crude demand and especially driving demand, the people on the bubble is what is going to make up that difference. You're going to have your contingent of people that are going to go no matter what the price, because that's what they do. They travel often, or they save up and they go on 1 or 2 big trips a year. It's the people that stretch to take that vacation that are going to have staycations, and they're still going to take time off. They're still going to go out to eat. They just won't travel. They'll go to the pool every day with their kids. They'll do special treats, maybe bowling, a movie night or the zoo. But again, all within a confined space, instead of driving from New York to North Carolina, South Carolina, Georgia, or Orlando. Again, these are some pieces, and we had friends that went to Disney during February break, and they were like, we knew Disney was expensive, but that was absurd. Was the most common comment made. And this is going across people, asked separately how they enjoyed their break, but all they could talk about was the price. And I mean, not to say that we're wealthy, but we come from a comfortable area, and these are the people saying that this is like a one and done. It will take years before they go back. And again, what about the people that are save up for it, that are now priced out of it again? That's the bubble that we're talking about. Those are the people that are not going to travel this year, and that's going to, again, keep us below. But when we say that we're not seeing a 40% drop, 10% below normal, 15% below normal, that's those people that are just not going to go because they can't afford it. And here's another little piece. Typically you start to get an increase in gasoline prices because you start to transition from winter grade to summer grade, especially when you start looking at some of the different levels. And as we've been saying, you're going to get a bit of a flatlining on gasoline. And not to say that we're going to go up or down. Typically we'll trend a little bit higher as we get closer and closer to May. But diesel is going to continue to normalize a bit, especially given where we are on the demand cycle. Still very low on the storage side, but demand isn't there, so you're naturally seeing that trend lower. Excuse me. Now, when we look at gasoline demand over the last 10 years, just to kind of narrow it down, you get an idea of how low we are versus historics. And again, we're not making new all-time lows. We're not going to. It's just going to be on the very low end of this level. And if you consider several points, one, we already ranted a bit about the economics, about the consumer, but you also have to think about less people going to the office. So that's Monday to Friday where you're below normal. But it takes time for gas mileage to improve. And the reason why is because the average car in the US is anywhere between 11.8 to 12.3 years old. And it takes time for 12-year-old cars to cycle themselves out. So now if you think about 12 years, you're getting close to 2010, 2012, you're starting to get into this level where we had a big focus on MPG and some of those different benefits. And that's now coming all the way through, and you're starting to get that pickup and just improvement in miles per gallon. So even though there was, I think, 1 month where we had a record amount of miles driven, we didn't have a record amount of gasoline consumed or gasoline demand on any metric, because people could say, oh, well, the gasoline numbers are skewed on any metric because, again, miles per gallon has gotten better, and that's just on average, and it'll continue to improve over the coming years as we get even older cars, again, getting cycled out. So when we look at propane, small draw, 540,000 barrels, still at the low end, still at the very high end of storage, flatlining, very similar to where we were in 2016. And just given local demand, we don't see that changing. Jet, about 300,000 barrel draw, slightly below last year in the 5-year. Nice pop in demand, but you can see that we normally get that increase, and we're just going to average out back to our level. The 12 weeks ahead, passenger flights decreased by 0.34% from last week. You can see just in general, week 1, week 2, week 3, you're starting to see a bit of that flatlining. So as we've been saying, even as passengers have gotten a bit more normal, you're just not seeing the same level of new flights coming on. Eurocontrol on the Euro area side still remaining on the low end as the U.S. passengers fall slightly below 2019 levels, but when you look at it against, especially looking at this chart, a little bit of above, a little bit below, it's also just in terms of timing, the weekends don't match up. Like, the 8th last year was it a Wednesday? No. So it's just you're going to get a little bit of those shifts, but you're pretty much back to normal on a TSA passenger side, just not on a flight side. And then open table continuing to stay fairly stable at this point. We're starting to see it slow down on the credit card side. We're starting to see it slow down. It has not shown up in open table. So again, pick your poison in terms of data points. The trend is down, but does that show up in April when it's nicer out and there's harder comps because people were eating outside? And so, people who still want to eat outside and they don't come back in the same wave, it's just good luck trying to call it, where we think it goes down. But again, it's just based on some of the other data points we're seeing because open table is still showing something fairly flat. So that's what we have you on the demand side. On the next segment, we're going to go deeper into the international markets and some of the shifts that we're seeing in other regions.